right now I'm going to be moderating this panel. We have all the big brands up here, and I'll just be keeping them on track and keeping them from ripping each other's throats out. We're going to be talking about some of the most controversial and topical points. I just got off the Solana validator call where we were talking about SIMD 123 and 228. What was marvelous, it was like 130 people, and I've never seen 130 macroeconomics experts in one room before, but we have evidently had them on the validator call. So it's a privilege to be part of the network. I'll start it off with Ben over there and let him intro himself and Temporal and what they're doing, and then we'll just run down the line.
Great. Yeah, sounds good. So I'm Ben. For those that weren't here for the last keynote, so I'm co-founder of Temporal, which is an R&D firm primarily focused on Solana. We do a lot of really in the weeds technical projects and research, right? So we do a lot of like MEV research, a lot of market structure research. We do a little bit of Solana core development here and there, and various other projects of that flavor.
Hi, I'm Anders. I run the institutional and DeFi BD at the Jito Foundation. We have three main products. We have the block engine, which runs, I think, 92% of stake on Solana. We have the largest stake pool on Solana with Jito Sol. And then we recently launched what I think is the only restaking platform on Solana.
Hey guys, my name's Nitesh. I'm the founder of DFlow. We're building a Solana DEX aggregator. We spend a lot of time thinking about execution quality, order flow, monetization, and improving the market structure on Solana.
Hey guys, I'm Eric from Pi Finance. We're building structured products for validators so they can create fixed term bonds and secondary markets for future yield.
Great. Okay, so you can see we have all the experts here. The first thing I want to get to is what's going on with MEV today. How has it changed over the last year? Because there's been a ton of developments. And where do you see it going in the next year? Ben, you want to?
Fair enough. That's a fun question. We've definitely seen a lot in the last year. I think a year ago, like MEV was not near as sophisticated than it is now. There weren't nearly as many players as there are now, and obviously volume was not nearly as high as it is now. So there's just a lot more MEV in general, just largely due to increased volume and network activity. I think the Trump coin launch was an all-time high in volume and an all-time high in MEV. I think both on Jito and, I'm sure everyone else extracting MEV, maybe not directly through Jito, probably had an all-time high that day as well. Jito turned off the mempool, which definitely shook things up a lot. I want to say like around last April, May. That's led to the rise of a few big private mempools that are extracting a lot of value, but rather than that value being returned back to stakers and validators like it was under the public mempool, most of that value is actually just centralizing into the hands of the actors that are running those private mempools. And it's again an insane amount of money. We've seen volume massively increase over the last year. So, but yeah, that's pretty much where we're at now.
Yeah, I agree with Ben. The scale has increased dramatically. I was looking at tip data the other day for something, and when we started, it was like there was days where tips were like below $1 on any given day, and now we're processing like hundreds of millions of bundles. So the scale has increased a lot. A lot is broken in the process, but there's also been really good improvements as part of this. So even though like a lot of the assets are maybe a bit silly that are getting traded right now, it's a great stress test, and it helps the infrastructure get in place to trade maybe what you would call more serious assets. So I think the other big thing is obviously MEV going back to stakers. So initially, like pretty much searchers captured everything. Now we're in a spot where stakers are seeing MEV be not on par with inflation, but a non-trivial amount of the rewards they're receiving, which is a really good change. So I think that's going to continue going forward. I think we'll talk about inflation going down, but I think like stakers will over time see priority fees and tips become the majority, if not like the main source of revenue for staking. So I think that's something that will continue.
State of MEV has changed a lot, I think, in the last year. The big thing, obviously, 12 months ago was like meme coins were starting to pick up, and over 2024, meme coins picked up quite a bit and then have dropped down a little bit, but they'll be back. Don't worry, they'll be back. One sort of like major change I've noticed, kind of DFlow focuses a lot on the order flow side of things, is a year ago, I think there was a lot of talk about monetization of order flow and extraction of MEV from order flow in order to monetize. I see less of that today, although the focus of discussions have shifted a lot more to kind of like how validators monetize. So this is one relatively big change from last year, along with the meme coin stuff.
I think it's super compelling. When talking to some of these other multi-chain validators, it really gives them, it makes them inspired, it makes them motivated, it makes them want to double down on Solana because there's actual traction. It's not just inflation-based rewards that are going to go to zero. So I think within the Solana ecosystem, it's amazing because the timeliness of this proposal to reduce the base rate inflation is it's here and it's meaningful. But to show that we're almost at a point that the MEV is accounting for that extra inflation is just great. And I think a lot of ecosystems are starting to pay more serious attention, especially on the validator front.
Okay, so one thing that we didn't touch on yet is the rise of these off-chain RFQs. One thing I've been wondering about is on Solana, can we tighten up spreads enough that we can be competitive on price with centralized exchanges? And it appears the answer so far, because we see these RFQs like Jupe RFQ, is not yet, because a lot of volume is going off to these off-chain RFQs. Nitesh, I wonder if you have any ideas how we can bring that back and bring all that activity back and keep it on chain.
Yeah. So this is a pretty like misunderstood topic. I think like the promise of Solana is to do everything on the L1. So I'm a massive bull of doing everything on chain. Very bearish RFQs, off-chain RFQs, off-chain liquidity, just anything that requires like permission. Fundamentally, the problem that needs to be fixed is market structural. It is a lot easier for a liquidity taker to trade profitably on chain than it is for a liquidity maker to trade on chain. The fundamental reason why this is the case is because liquidity takers have this luxury of being able to wait and decide when they want to trade very purposefully. Liquidity makers always have risk exposed on books that are on chain. So with the structure of the Solana network today, with leaders that rotate, like single leaders that rotate, a market maker necessarily has to widen out because they don't always have the ability to cancel a quote. So there are a lot of changes, one, that are coming at the sort of like microstructure level of Solana. I think there's a lot of improvements that could be happening at the application layer as well. The one that DFlow focuses on is called conditional liquidity. This effectively makes it a lot easier for market makers to provide tight liquidity on chain. Requires no changes, works today. So check it out.
Okay, good. I wanted to get that one out of the way. Another way, something you mentioned is, this rotating proposer monopoly. And I've proposed, hey, we should probably get rid of that monopoly by moving to multi-leader. Does anybody on the panel have thoughts on, should we be going to multi-leader? Does it look promising? Is the tech there? How long do you think the timeline will be?
Sure, I'm happy to talk about it. Like I definitely think it's better than what we have now, right? Maybe like I think everyone knows that this is a problem, and I think most people that have kind of seen this play out at this point are fairly confident that the current Solana protocol as is, does not enable a market structure that, fundamentally will have spreads that are as tight as what you see on like Binance, OKX, etc. If you get multiple concurrent proposers, without going like too much into, technical detail, it does enable various market structures where, I think you can actually get spreads that are as tight as what you see on Binance, what you see on OKX. Now, is that the only solution, right? There's been people, for example, on the Fire Dancer team in the past that have said, maybe we don't need the complexity of multiple concurrent proposers. Maybe we can just do super short slot times, right? So, maybe there's debate on, what exactly is the proper solution. I think, what you're still missing with, even shorter slot times is that concurrent aspect. Like, I think it's really hard for another decentralized system to be competitive with one that has that concurrent aspect. I could talk all day about, what exactly that does enable and why exactly spreads should be tighter. But, I'd say that something needs to be done quickly because, we're seeing, all these DeFi protocols now, leave DeFi, build centralized RFQs, single sequencer ETH L2s, the whole new L1s, right, that are more centralized, just so they can avoid their users just getting consistently destroyed on chain by, sandwichers and takers, and like the proposer rent is pretty bad, as you mentioned. So like, I think it'd be a lot better than what we have now. And, like I'd say that we definitely support that.
I have another reason why I think people are leaving. I think it's it's also part of a business thing. Like a lot of people are coming to Solana because there's a community, there's people, there's actual users. But it seems like what happens, it's very extractive. It's not good for the ecosystem. But I've seen I was in Ethereum for a long time, and what you see once people get enough critical mass, they just launch their own chain. Why? Because they can launch staking, or they can do anything. They can do their own thing to make their own money, right? And I think it's just not good as a whole. But I think the way you're approaching it makes a ton of sense.
Okay, let's shift gears a little bit because I think the people are waiting for the red meat. Okay, so the first thing I want to start with in terms of governance is we just had SIMD 96 pass, or sorry, not pass, but be activated on mainnet. It passed a while ago. Yeah. What that did is it took the priority fee, which was previously half burned and half sent to the validator, and it made it all sent to the validator. So there's a bunch of economic reasons behind that, but more generally, it just kind of increased the validator rewards, and it called into question this idea of how do we make sure that those validator rewards are being passed on to delegated stakers who aren't running the validator themselves? Should those be passed on? I wonder what we're about like 2 weeks into the activation. I wonder if anybody's noticed anything starting to happen, or do we have to wait to see these effects play out over a longer timescale?
Is it all on me again? Yeah. So, like I don't think there's been any insane changes that have happened, right? I think that I think it like I don't know, like most validators run, like a scheduler that can't really take full advantage of this change quite yet. Like a scheduler. I mean, there's like multiple schedulers that run in the client that most validators run, and those schedulers kind of compete with each other, and they don't really take full advantage of this change. We might even see full advantage of this change as more people start to adopt like Frankendancer, which has a much more like profit maxi unified scheduler than the one that most validators are running right now. Funnily enough, validator income from block rewards is actually lower because we have this huge downturn in volume that happens right about when this SIMD was activated. But, I think as schedulers get more sophisticated and validators get more sophisticated at block packing overall, I think that in the long run, this will translate into more revenue for validators directly through the protocol and just less unnecessary burn and the backroom deals that we were seeing happening.
I'll speak to the staking side of it. So I think that this is really good for LSTs as a whole. And I think you've seen pretty much all the major LST players start to announce some change around this. So I think like Sanctum launched basically one LST for every validator. I think Marinade had something. We'll be releasing something at Jito shortly as well, because LSTs are just a much better like infra to use for distributing these rewards, because you just send everything to one stake pool and the share accounting is all done for you. Whereas we're seeing like native sharing is quite difficult. So even with something like Jito tips, if you have a native stake account, you have to go claim that manually. So I think this is good for LSTs. And then I also think that this will start to go back to users more and more. Just takes a little bit of time.
Yeah, I agree with both points. I think fundamentally, it's probably just too soon to see the effects of this sort of change. Probably takes longer for it to propagate across, or for the market to react and make things efficient. So, probably see stuff in the next couple months.
Yeah, I think it's interesting because if you've ever seen any of these validator SLAs that they offer to their more institutional clients, block rewards are part of it. Now this is going to be part of it too. It's just something else they're bundling in because they don't have to disclose it, but they're just basis points that they're offering to these people based on like the term of their lock-in. So I think what will inevitably happen is back to everybody else's point, is it's all going to get exposed. Everyone's going to find out exactly what it looks like, how much they're making, and then eventually it'll just it'll migrate its way on chain, either via LSTs or just people competing for a native validator stake and saying, this is what our historical APY has been by bundling everything as an all in.
Yeah, so that kind of leads us into the next question, which is we have on the docket right now, we have SIMD 123, which is a nice number actually. And that would basically put native priority fee redistribution, block reward distribution in the protocol. So I wonder what people's thoughts on that are. It seems like the validators are a little worried that this is going to accelerate the timeline of competition for new stake and make it more transparent so they won't be able to get their block rewards anymore. Are people worried about that? Is that a good thing for the system or a bad thing?
Yeah, so I think to the point about the validators, I don't think it'll go straight to zero like a lot of people expect. Like we see a lot of there's good validators with zero commission, but people definitely get away with like 8% and even higher even now. And then same thing with like MEV commission. Most people aren't at full zero. So I think we'll see similar dynamics with priority fees and potentially higher than the last two, just because it's one, more performance based. So there's probably more value added by the validators there. And then two, it's kind of like the last frontier of revenue for now. There's not like a fourth thing they can tap into. So I think they'll be a little bit more defensive with it. But as far as the SIMD goes, I think it's definitely needed. I'd be curious about like timeline for implementation. But I do think that this is like a pretty inevitable thing to go back to stakers.
And a follow up on that for you, Anders. You guys have demonstrated the first profitable restaking protocol, which is Tip Router. Do you want to say anything about that?
Yeah, I'll plug one of our products. So while you wait for SIMD 123, Jito has the Tip Router protocol, which is what we use to distribute all of the MEV tips to stakers now. So that's like the first product built on Jito restaking. And so we're exploring ways that could be used to distribute priority fees as well. So I think we've had a few like private conversations about it, but we'll start getting more public on that soon as well. But just to plug Geo restaking, so we are, I think there's like 150 mil, maybe 200 mil of security in it. And we're now distributing a couple million in tips a year to restakers. So we're in kind of a weird spot because most restaking platforms, they have like this huge capital base. Like some of them are like over 10 billion and then they have effectively zero fees. Whereas we have like quite a bit of fees in the smallest capital base. So if you haven't checked it out, the yield is pretty compelling. And then Eric can speak to the DeFi part of that.
Fucking gangster. It's ridiculous. I love it. I love it. I love it. Yeah, I think for how we're focusing on this space is so for context, we built a DeFi primitive that allows people staked natively in validators to access DeFi. Right. So like we built something called the yield marketplace where you could forward sell your staking rewards quarterlies on a quarterly basis. And we have some other things that we're cooking under the hood. We've been in stealth mode for a while building stuff. But it's interesting when you start talking to these validators, you start talking to them and saying like they all have these businesses, they have these P&Ls, they have these stakers, and they're all trying to figure out what else is coming to them. So I think outside of just what's happening on chain, it's about adopting new primitives and starting to evolve by offering different services to those staking tier validators. Because right now it's just like everyone's competing over fees, SLAs, and like whatever they could do technically, but no one's offering services. They're offering products. Like it's a super commoditized business, as it sort of should be at the end of the day, because you're just running bare metal or like running on AWS, right? So I think you're starting to see the validators grow up and you're starting to see people take things more seriously. And just for what we've been building for the last couple of months, the reception's been unreal by talking to the validators. Everyone's excited. So yeah, I could definitely speak to it from that. And then like even talking to their customers who are excited because they want this hybrid approach of like, how could I get the trust of my SLAs? How could I stay in my custodian, but also how can I play around on chain and like better support Solana without having to go somewhere else? So it's pretty exciting.
Yeah. All right, let's move on. We got 228, my baby, which is a proposal to make Solana emissions more market based. And that's what we just had like a 2-hour debate among all the macro econ experts on the validator call about. I think we heard Ben's thoughts in the last talk, but I wonder what everybody else's thoughts are on it. And also, what do you think it's going to pass or not?
So I haven't been in these expert meetings, but my general sense is people want inflation to go down, so I think it'll pass. I think what it will do is it's going to make the role of delegation and operating a validator much more important. So if you go back to like 2020, 2021, like everyone's getting effectively the same inflation rate. And then the only lever to pull there is like, do you charge 8% or 4% commission? So it's a pretty standardized yield. But now that we have 3 sources of revenue and the like kind of guaranteed one is going down by half, I think you're going to see that you can't just like kind of stake anywhere and expect the same return. And we're already seeing like the range of returns for staking in different places increasing. So I think that's going to accelerate this quite a bit and make delegating and operating validators like a much more hands-on job than it was before.
Fixed income markets and traditional finance are like some of the largest, so it's pretty exciting to see more based mechanisms come to like primitives that are just totally unique to blockchains. So big fan of this. I don't know if it'll pass, but hope it does. Also not in those macro econ meetings.
Yeah, I have not been. I've read. It's super interesting, but I think it also plays to the state of the ecosystem. It's like if there's enough MEV, there's enough block awards and everything to go around. It's like it should be down because in some cases I've been looking at the APY and it's like 13%. It's like this is ridiculous. This isn't good for anybody in the long term. Short term, everyone loves it, but long term, no, it doesn't scale. And also, I think if you look at where the institutional adoption is going, we start talking to these big boys who are looking to launch ETFs. It's hard to raise money. Like, how are you going to raise money to launch an ETF when the APY is 13%? They'd be way better off staking it or doing something. And then there's all this, deflation. Like, it's just ridiculously inflationary. It doesn't work out. So I think this is net good for the ecosystem as a whole. Just people aren't going to like it in the short term because it forces you to put on your big boy pants and go to work instead of just, hanging out in your hoodie and playing DGen games, running a validator on AWS.
Yeah, I think definitely the role of the validator is going to get a little bit more sophisticated, but I think also commission is already pretty low, so it's unclear how much this is going to affect the bottom line and the operating costs. There's another proposal. So we've talked about 123, we've talked about 228. There's 224, which has been way overshadowed by the other two, which is also about to be in discussion. And that one is fixing a vote mod. So I think that proposal is pretty uncontroversial and technical, but I did want to raise this topic of vote mods. We've seen a lot of activity around timely vote credits and vote mods. Do you think that will continue, or do you think that I will be able to patch all of the vote mods so that nobody can do them anymore? Or do you think there will always be more and more vote mods that people are doing and more sophistication required to run a validator?
Yeah, I mean, there's always going to be profit maxi stakers out there. Many of our stakers at Temporal, we've got millions of soul staked, and these stakers are profit maxis. Like, they want the best returns in the game. I mean, like, aside from maybe sandwiching returns, like, we don't sandwich anyone, but other than that, like, they want the best returns in the game, and thus we have to provide them the best returns in the game, lest we lose those stakers to someone else, right? So we and our stakers are naturally going to follow the incentives that are laid out. But I would definitely agree with Max here, is that like the game is largely broken, right? Like both the current voting algorithm and like the current protocol, right? Just like I mean, like, the protocol creates an incentive where, like, it just, how do I even explain this? Like, there's just a really dumb mod that you can do that you shouldn't really be able to do, and like just should never have existed in the first place. It's just kind of a dumb incentive. So we do that. We slightly mod our validators, and it just picks up some extra money that we would otherwise lose for stakers. It's not really harmful to the protocol. Like, it's kind of just picking up free money that's on the ground. And yeah, I mean, it's probably a net good thing to remove the incentive to mod something that is as, let's say, dangerous as voting, right? Because if you mod that the wrong way, then you could be responsible for a network outage or something like that. So we're very careful about that here. Everything that we do with our validators is tested, and obviously we would never do anything that was harmful to the network. But yeah, I mean, like, I think like IVC definitely, which is the SIMD he was talking about, definitely makes sense, and like that incentive never should have been there in the first place. Like, that said, I think there should always be some incentive to be performant as a validator, right? It's like right now we see that in the form of timely vote credits. We see that in the form of just different block packing strategies, different schedulers and stuff, right? So like the validators that are really good at like this low latency, like high performance computing stuff, I think they're always going to find ways to, edge out the guys that are kind of just, like they have their SFTP stake, they're probably paying someone else to run their validator and then just like collecting money for free. Like, I think we'll see those guys probably start to get squeezed out, but this will lead to the rise of more and more higher performance validators, which I think in the long run will be good, and it will just push the network to be better and more performant. Not just at the protocol layer with all these changes we're making, but just also the validator and infrastructure layer.
Okay, we have 5 minutes left. I want to give everybody the opportunity to give us their hottest take on where MEV and staking is going in the next year. And then if we have time after that, we'll do a lightning round of even hotter takes, which I will elicit from you. Maybe we'll start with Eric.
I think we're about to go through a really tough time just with all the things that are happening and a lot of the drama. So it's going to be a brutal few months. I maybe another month, with the FTX unlock happening and just a lot of FUD in the market. Over the course of next year, I think we've definitely crossed the chasm in terms of adoption, in terms of technology, in terms of growing up a bit. And I think with the APY coming down for the inflationary APY coming down, I think it's just going to be nothing but upside, and more people are going to find innovative ways to take advantage of MEV, because we've seen the revenue, we know it works, so really excited.
I've had this hot take for a couple years now, so hopefully it's starting to become less of a hot take, but we'll see. I think that maximally extracting MEV from retail and returning like a percentage of them in some auction is bad market structure that will always just end up hurting retail in one way or another for many different technical reasons. The main one I will point out is that it is just very information leaky to the market, and you can't really get around that without basically removing the effects of being able to compete to get to 100% of value return to retail. So that's my hot take. Don't know if it's still a hot take, but hopefully not.
Yeah, I think this idea that users like open their Phantom wallet and then they like look through a list of validators and then pick one. I think this like delegation is going to become completely obfuscated, and people will not be like choosing validators on an individual level unless they're like an institution or they have some deal with it, because the complexity is increasing. I think like you saw maybe a year or two ago, like validators would charge 100% GITO commission and stakers just had no idea. And so I think it's going to become something that people have to be increasingly active on. And I think we're already seeing this, like wallets are starting to become opinionated about where to stake. I think like more and more apps are going to continue to do that. And soon it's going to be at the point where it's pretty much all managed by a select number of parties.
Yeah, I mean, like I say, MEV's going to continue to get more sophisticated. It's going to continue to get more competitive. Validators are going to continue innovating more and more solutions to edge out their competitors. Stakers are going to keep innovating solutions to edge out competitors. And, searchers and traders will keep innovating new, ways to edge out their competitors as well. Like especially with, SIMD, the block reward sharing SIMD, validators are going to turn to other revenue streams. They're going to try to find other revenue streams. I won't really say what exactly these revenue streams are, but, I think validators are going to get, a lot more creative, and they're going to find, a lot new ways to monetize. And, I think it's very important that, we from like the protocol and core development perspective, make sure we're very aware of the incentives that we're creating here, and, that we're very aware of the ways that validators might try to monetize. And, I think it'll be pretty important to prevent like harmful ways that validators can monetize, which, they may or may not turn to now that they're losing, out on their normal revenue streams like inflation rewards and block rewards.
Okay, so we got 1 minute and 30 seconds left. The rules of this round are you cannot respond with more than one word to the question that I ask you. You can not say anything. You can say no comment. You can say yes, or you can say no. Okay. Ben, was it a mistake to turn off the mempool?
Yeah.
Was it a mistake to turn off the mempool, Anders?
No.
Nitesh?
No comment.
No comment.
Okay. One thing we've talked about in addition to 228 is, should the protocol do long-term staking in protocol? Eric?
Yes.
Nitesh?
Yes.
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 Okay. Is MEV good or bad for the ecosystem? Ben?
Bad.
Neither.
There's no answer to this.
I think it's good.
In 2 years, will GITO still be the dominant block builder on Ethereum? Or not on Ethereum, on Solana. Sorry. Sorry, you guys are going to have to give me a few months more to get that out of my system. All right. In 2 years, will GITO still be the dominant block MEV solution?
Probably.
Probably.
Yes.
Probably.
Okay, is Solana going to win?
Yes.
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 Okay, thank you to all the panelists. We're out of time. Thanks, everyone.